Hi, everybody. Welcome back to another exclusive CEO interview on Stocktwits. I'm Katy Perry, and today we're diving into the numbers behind one of the biggest Q1 standouts in digital gaming and affiliate tech. That is gambling.com, ticker GMAB. This company just dropped record-breaking Q1 results. We're here to talk about it all. Joining me now is Charles Gillespie, CEO and co-founder of gambling.com Group. Charles, welcome to the show.
Hey, Katy. How are you?
I'm great. We were talking outside of the show. I've been talking to a lot of people about the ecosystem that you operate in, and I think it's a great time to talk to you because I know you had revenue up 39%, EBITDA soaring past 55% growth, strong beat on EPS, but you also had an acquisition. So we have We got a lot to talk about today. Congrats on the quarter, though. First of all.
Thanks very much. Yeah, it was a very busy quarter for us, record quarter across the board. We've started talking about the business in two sides now. So we have our marketing business, which we've always had. That's our core. That's where we come from. That's what we do. That's where we help online gamblers find online gambling sites and then get commissions from those sites. And we helped 138,000 accounts get opened just in Q1, which was a record. So that business has never been in better shape, but because it's in great shape, we've started to think about what's beyond that and take some of the money we're making and deploy it for acquisitions that'll add on complementary businesses to what we've already got. And so we closed this acquisition on January 1st for Odds Holdings, which is a company that owns OpticOdds and Odds Jam. Odds Jam is a B2C product. It's an app. You download the app. You have to pay for it. It's a premium subscription sort of thing. And when you do that, you get access to premium odds, arbitrage opportunities, middles, all sorts of stuff. These guys basically have the best odds data in the world, and they leverage that to make really cool stuff. The other thing that they do is a business called OpticOdds, where they sell essentially risk management software to the actual online gambling operators themselves. So if you're Bet365 or FanDuel or anybody else, in order to run a modern sportsbook, you need to know where everyone else is at on price. Otherwise, you can get hit pretty hard by that sharp money. And that's what OpticOdds does. So it gives them a kind of lay of the land in terms of where everybody else is at, which helps them manage their book. And they had a great Q1 as expected, and that sports data services, which is this new side of the business we're talking about now, that was 24% of group revenue in Q1, and we expect it to be well over 20% for the full year. And that also includes some sports data services we have from a company called Rotowire, which we bought a couple of years ago. All that together is about a quarter of group revenue, and that business is growing faster than the marketing business. The marketing business is still growing, still a high growth company, and on both sides of it, but the sports data service is growing faster. So when you think about us getting to our next goal of 100 million in adjusted EBITDA, on a like for like basis, looking at the margins of the two businesses and everything else, that would be 30 to 40% of that 100 million, given that the margins are basically the same between the marketing business and the sports data services business, and that business is growing faster.
The data layer to me is so fascinating because I think it speaks to just the sophistication that your industry has moved to. I was meeting up with a friend over the weekend, and her partner was there, and he was talking about the processes he applies and the research he does and the data he sources when he does his sports betting. And I think when you think about that, you think about what are the adjacent businesses that could grow alongside gambling and sports betting. And media certainly is one you've kind of built the company around, but the other side, the data side, is fascinating. And it sounds like having the B2C and B2B, which having both sides, the B2C and B2B, you can almost diversify from within the industry itself, where users are using that data to better their chances of winning. and then the platforms as a risk mitigation.
Yeah. I mean, the way we think about it is we have great relationships with these online gambling companies. We have a very substantial commercial team. The commercial team's in a great place to sell more to these online gambling operators, help them solve more problems that they have, given that we already have these fairly deep relationships with them. So selling them additional things like OpticOdds, risk management, or even other data driven businesses could be interesting in the future. So it really gives us a platform to do a great many things in the future. And it's, it may sound simple on the surface, but it's actually some very sophisticated technology behind the scenes to do it quickly. Anybody can kind of copy paste odds from one operator to another. If you do it slow, it's not interesting or hard. The tricky part is doing it incredibly fast at very low latency, because that information is only useful for a very brief period of time. And these guys, they spend upwards of $1 million a year just on compute to crunch the numbers that they're pulling in from all the different operators. So, it's not the easiest thing to go out there and replicate.
Yeah, and I mean, owning the data seems like such a competitive advantage no matter what space you're in today with LLMs and AI and automation. Are you guys thinking about applications for how this data could be leveraged in that way?
Yeah, definitely. Every year we have an annual theme, and this year's theme is preparing for your AI future. And we've tried to bang the drum and get everybody excited about adopting AI in all corners of the business. The obvious place is for the technical team and the developers to use it to program faster, and that's kind of table stakes at this point. But we've got the commercial team using it to analyze pricing. We've got our content team using it to streamline content production. Even HR and finance are using it to streamline different internal processes. And when it all comes together, I think we're going to see some pretty significant productivity gains across the whole economy.
Very cool. I want to shift to this NDC metric, which is an important metric you guys share out. So that's new depositing customers. You added 138K in Q1. Can you just break down why do you measure this metric in particular? Where are they depositing? And also, what's working on the customer acquisition front that's leading to that growth rate?
Sure. Okay, so this is our main non-financial key performance indicator. It's what me and my co-founder and the senior management team look at day to day to run the business. And it's, a lot of investors out there might think we're a lead gen company. We're not a lead gen company, because what we're selling to our customers isn't leads. It's an NDC is a new depositing customer. So they have clicked, they have registered, they have deposited, and they have played. Okay, so that is cash money in the bank for our customer buying that NDC. The operators at the moment, they're very into this same game parlay product, where basically you can make a parlay based on various things happening within the same event. That used to not really be possible and wasn't much of a thing. Now that it is a thing, people love it, right? And it's basically like a baby lottery ticket. Okay, you go pick 5 or 6 random things you think are going to happen, and because they all have to happen in order for this thing to pay out, the odds get very long very quickly, right? So you could have 1,000 to 1, 5, 10,000 to 1. In which case, unlikely you're going to hit it. But even if you don't hit it and you get close, it's going to be very exciting. So the kind of entertainment ROI on that product is pretty high for the user, but the operators love it because it's, with the way the math works, it's a pretty high margin product. They make a lot, they expect to make a lot of money off of those same game parlays, and they have done over the last couple of years. It's been a key driver of sports betting in the US.
Yeah, I think that the same game parlay too seems like something that's bringing more people into sports betting than maybe were there before. I was never into it, and then I started setting up some parlays for the NCAA women's basketball tournament games, and that was like the hook for me. It was super fun, and I put like $5 in, and I think that's interesting too when you think about you can expand the number of people participating. but at a lower buy-in. And so it's a little different than, your big heavy gamblers who are throwing around, tens of thousands of dollars. But yeah, I think that piece is really interesting. And how much of your business do you think is kind of tied to the shifting behaviors and the expansion of the sports betting market here in the U.S., but also globally?
Well, sports betting for us used to be pretty small. We're a casino-first company. That's where the money is at in this industry. If you walk into a casino in Las Vegas, the sports book is about this big, and then the casino floor is enormous. It's for a reason. But of course, sports betting has been the big driver of everything in the United States over the last couple of years. So we've gone in headfirst on that, and it went from being an insignificant part of our business to North America overall being 60 million in 2023 and a hair under that in 2024. So it's an enormous part of our business now. Not quite half of group revenue, but a very substantial part of the business, and that is driven by sports betting. I mean, iGaming and online casino games is obviously a part of that. But that also includes Canada. And so when you look at the kind of U.S. sports betting alone within those figures, it's smaller. But, it's been the biggest growth driver in the entire industry for the last couple of years. We don't have quite as many new states launching. The only one we're expecting this year is Missouri. And we don't add new states to our guidance until the launch date is basically written in stone by the regulators. So Missouri, we think, is going to go on December 1st, but we haven't put it into our guidance yet because that's not totally confirmed. If it is confirmed before we report Q2, we'll add it to guidance when we report Q2.
Such an interesting nuance of your business and others in your space, of that detail of, a lot of people can make assumptions about things that might happen in their guidance, but the way the policy is moving, it seems sort of all over the place. And so you have to sort of hedge a bit and wait until things are firmed up. You mentioned guidance. You're guiding for $170 million to $174 million in revenue and $68 million in adjusted EBITDA. What assumptions are built in into that forecast? So if you're not building in the Missouri expansion, what are you banking on happening to reach that point?
Yeah. Good question. Well, the guidance, just to be clear, it's 67 to 69 million is the range on EBITDA. We need the business to continue growing, obviously, but it is in a great place. Q1 landed exactly where we wanted it to land. A lot of the growth this year is coming from OpticOdds and OddsJam. But the marketing business is absolutely growing and is going to put in a nice year as well. We bought some very nice assets last year when we acquired basically the heart and soul of XL Media, which was the original publicly traded affiliate in London. Those assets have seen better days, and under our management have dramatically increased their production of new depositing customers as well as the revenue that's coming off of those assets. So that will be a key growth driver this year. And then Rotowire we've got bigger expectations for Rotowire than we have done in the past. Rotowire is the original authority in American fantasy sports. It's a 25-year-old business that we acquired in 2022. And for the first couple of years, we had a little bit of like a hands-off approach to it. They've got a team that's been there for ages. The founders are still involved to a certain extent, and they had a winning formula we didn't want to mess up. We just wanted to kind of graft on our particular brand of digital marketing and make some extra money off of the performance marketing side of things, which we've done, and that's worked exactly as planned. But that core business, we wanted to give it a little bit of breathing room, make sure we truly understood it before we made any kind of more invasive changes to it, if you will. And the whole thing is going to be relaunched this summer. So brand, product, distribution, all of it is getting a major upgrade. Basically, the only thing that's staying the same is the underlying data that the users of that product obviously pay for and is very valuable to them. But the packaging is going to be thoroughly modernized. We think obviously in a big way and in a better way, and that is part of our growth plan for the second half of the year.
Very interesting. We'll be on the lookout for that. I want to talk about adjusted EBITDA margin. You came in at around 39% from 35% last year. You talked a little bit about, AI tools being more productive, but what do you think where are these operational efficiencies coming from more specifically?
Yeah. Look, there's economies of scale. As you get bigger, you have more data, you leverage your technology investments further. The margin does vary quarter to quarter. It was down, I think, 100 basis points quarter on quarter, but up 400 basis points year on year. So we think that the business, is going to run at a kind of 39-40% adjusted EBITDA margin profile going forward. The OddsJam and OpticOdds acquisition actually had slightly incrementally better margins than the marketing business, not meaningfully different, but slightly higher, and that would have brought it up a touch in Q1. But yeah, it'll bounce around, right? There is some seasonality in this business. If we put up a quarter and it's 37 or 38% adjusted EBITDA margins, it doesn't mean the business is struggling or margins are compressing. It's just the inherent volatility of the gambling marketing business. The next quarter it could be 41%, right? There's just a degree of natural volatility in there.
Yeah, it is. It does shed light on just needing to understand the industry as an investor and it functioning unlike maybe some of your other investments. And you hear about that voiceover a lot, DraftKings, Flutter, when they talk about their earnings and talk about the impact of win rates and how that impacts their businesses. But what's interesting about you guys, though, is the new data acquisition you have, this data services layer. That's a different kind of revenue model where that's more recurring. So can you break down, sports data services now 24% of total revenue. Is that mix expected to grow? And at what point do you start seeing yourself as a SaaS or a data business?
It's definitely going to grow. Both the marketing business and the sports data services businesses are growing, but sports data services is growing incrementally faster than marketing. Thus, it will, its proportion of the overall total will increase. We are starting to try to tell the story that we are more than just a marketing company. And, when you look at the bottom line, or, at least adjusted EBITDA, the flow through is basically the same for sports data services. The margin profile of the two businesses being very similar, you can read that through to adjusted EBITDA. So roughly a quarter of adjusted EBITDA is from sports data services. And, true B2B SaaS businesses have very high multiples. And, the core of that business, the OpticOdds proportion, that's long-term contracts with enterprise customers. We absolutely should be getting a very attractive multiple on that business. And then you've got the B2C side. Okay, that's shorter term subscription, but it's still subscription and it's still recurring. And then, if you zoom out a little bit more and you factor in the recurring proportion of our marketing revenue, a lot of the players that we refer to our operator clients are referred on contracts that have some sort of tail. We get a proportion of the net gaming revenue of the entire pool of players that we have sent to the operators. And that, when you add that on, that's about 25% of revenue. So you look at that proportion of recurring marketing revenue in addition to the, totally fully recurring revenue from the sports data services side, and it's half of our revenue.
What's interesting about what you just described is just how, on the surface, if you think gambling.com, a media company, you think advertising revenue, you might equate that to something like a Meta, maybe a Google to some degree. But what you're describing does have the subscription layer, does have the SaaS layer, and also the marketing layer. So I think it's just important to articulate this. And this is why I think it's important to sit down with people like you and kind of go beyond just like the headlines and really get to the heart of how you're building the business.
Absolutely. There's a lot more going on than just affiliate marketing on gambling.com. I mean, that's, we have 50 or 60 websites, there's a lot more happening there underneath the hood, and the predictable recurring nature of the revenue is, I think, something we're not getting full credit for just yet.
Yeah. I want to end on capital allocation. We've discussed some really exciting M&As, whether it's the data services layer you're adding, the purchasing of a legacy property and sort of souping that up for the future. Should investors expect additional M&A this year? And if so, what sort of things are you thematically interested in?
Yeah, it's entirely possible we would do another deal this year, although we are very picky. We don't do a lot of deals. We try to do kind of 1 to 2 a year. We don't need to do deals to grow. We have very substantial organic growth in the business, but because we are, we run a very attractive business model, it generates a lot of cash, and we are, extremely efficient in how we convert adjusted EBITDA to free cash flow. We're converting on in a normal quarter, kind of 80+%, maybe 90+% of adjusted EBITDA to free cash flow. So we generate quite a bit of cash. We have an incredibly efficient tax structure for the business, and look, we can do something with that. So either we buy stock back, or we do acquisitions, or pay down debt. At this point, we have drawn about 90 million of our 165 million credit facility. So everything's on the table. We're not under any pressure to do anything in particular. We would have liked to have seen a more positive reaction last week in the share price, and if our plans for the second half of the year come together as we expect them to, and we don't see movement in that share price, then I think we'll start seriously considering additional buybacks. But ordinary course of business would be to accumulate cash and buy the right thing down the road to maximize shareholder value.
Great insight. Charles Gillespie, CEO and founder of gambling.com. Always good to kind of learn about an industry we all see in our everyday lives, but maybe don't know how some of the adjacent businesses work. So really appreciate you coming on and giving us a rundown of the earnings.
Thank you, Katie.